The session will be handled by our own past Central Council member, CAK Sri Priya ma'am. She was the past Central Council member, heading Continuing Professional Education Committee of ICI. She also served the Regional Council for the term 2013-16. She is a practicing chartered accountant having more than 20 years of professional experience. Prior practicing, she was worked as a Deputy Manager, Transactions Advisory Services in a Big Four firm. She also worked as a Deputy Manager, Financial Analysis at Ford Motors. She is a Commerce graduate from Ethiraj College for Women, did her schooling in DAV Higher Secondary School. During her school and college days, she was an active member in NCC, represented the state of Tamil Nadu in Republic Day Camp 1992 and adjudged the All India second best cadet in the senior category, represented the country in Defence Students Exchange Program to the United Kingdom. With this short brief, I present before you CAK Sri Priya ma'am. Before we hear ma'am, let us rise for ICM. Thank you, delegates. Over to ma'am.
Here's a very, very hearty good evening to all of you, and thank you so much for being here today. Just a small request. Feels a bit queer to address a whole bunch of empty chairs right at the beginning of the stage. So if you want to come in, a few of you forward, I'd be very grateful. With a very clear commitment that you can leave whenever you want to, so it hardly matters. In fact, I was asking Rahman, I'm sure this 190 is going to be sort of the floating people who might just sign and leave. And so I've been asked to do a session on risk-based internal audits with a few case studies. And for today, I've picked two large themes. One is procurement, which is sort of very common for everybody. And the other one is contract labor, just for a flavor of how you actually approach a risk-based audit in these two segments. The other ones popularly would be your revenue cycles, etc. Now, before we actually start, I'd like you to take a small survey on your phone. Interestingly, I had set this survey up exactly an hour back on a site called menti.com. So if you can just go into your mobile and log into menti.com, and you just have to use this code 574550. Even if a few of us can do it, it'll be good. It's just got one question: ever applied risk-based audit approach in your work? And there are only 3 answers: yes, no, or sometimes. So I think somebody's been doing it now, because the numbers have moved from 347 to 352. So about 352 chartered accountants have taken this survey in the last 1 hour or so. And these are your results in front of you. See, 353, it moves. So it's largely intended to sort of make it interactive. And for my own appreciation on how popular it is for people to be using RBA to do their work. So if you look at it, the results are actually very scary. It appears that, and I've been sort of consistently monitoring this, I find that at any point in time, it's only half the number of people who say that they take a risk-based approach to their work. And today what I speak does not have to be risk-based internal audit. I think it's risk-based audit today. And before I start this, I'm actually going to try and give you instances from my own work across the process spectrum that I have worked in the areas of procure to pay and contract labor. So, but before I even start, I think it's absolutely important to recognize that as a fraternity, we are on the threshold of what I think is a make or break point. If you take the string in the stream of failures that we've been watching, am I on video? You can actually switch it off for some time. So of the 372 presumably chartered accountants who've polled in, only 181 say that they always use risk-based approach in their work. 86 say no, they've never used risk-based approach. 105 say sometimes. Now before you get into risk-based approach, what's the other approach to audit? The other approach is your transaction approach to audit. Now today, which company do I mount a transaction-based approach? Is a company which is very, very small, or an auditee who's very, very small, or an auditee whose transactions can be extensively sampled. So if I have only 300 transactions during a year, then I can use a transaction audit approach. But imagine my company doing 300 transactions in coal trading with a turnover of 300 crores. Would you still mount a transaction audit? I might not. Let's say it's a steel manufacturing company which has got only 300 invoices a year and handles about 5,000 tons of steel or 10,000 tons of steel. You can't do it. So your decision to use a transaction audit or a risk-based audit will depend on both the volume of transactions as well as the complexity of business. Suppose my client is let's say a company that's doing build, operate, transfer projects. Let's say they make roads or toll roads, or they do EPC activity. Then I cannot follow a transaction-based approach. It essentially has to be a risk-based approach. Where else do I use a risk-based approach? I use a risk-based approach where my client has a lot of forex dealings. I have forward contracts. I have contracts which stretch over the next 8 to 10 years. I have huge capital equipment purchases. I deal in commodities. You know, some of you might be dealing with clients who are on your cashew trading, for example. Huge turnover, 800,000 crores. They buy cashew from, let's say, Africa and they sell it in India. Those kind of entities will have to go through essentially a risk-based framework. So where does all this begin? Why do you need to do anything? You need to do something in terms of an audit, internal, statutory, but whatever you call it, self-assessments, reviews, because it all stems from corporate governance. And this whole concept of corporate governance evolved because ownership was divorced from the management of the company with the advent of the joint stock companies. The shareholders own the company, whereas the board runs it. And hence you needed to have a corporate governance framework. It's a term that broadly refers to rules, processes, or laws by which businesses are operated, regulated, and controlled, and means that corporate governance is both about opportunity and about risk. But as an auditor, I am concerned only with risk. Largely risks to the balance sheet, by whatever name they are called, and risks of fraud or error which could materially vitiate your financial statements. That's what they say, right? And an audit is a process where you express an opinion on the financial statements, whether it's true and fair, and whether it's free from any material misrepresentation. So if there are small errors, nobody is too hung on it. And accountability and risk management are the core objectives of corporate governance. And the New Companies Act has put in lots of aspects on corporate governance. In fact, I keep saying this, the New Companies Act, ACT, is not a noun, it's actually a stream of adjectives. It stands for accountability, corporate trusteeship, and transparency. Now, if you look at it with this, and today, in some sense, this Companies Act has become a mother legislation. So whether you're auditing or a company or a non-company, going forward in the future, I feel the same benchmarks that you adopt for a company audit, you will have to adopt for non-corporate entities also, which is why you need to be a little more careful. For example, if you're doing the tax audit of an entity and you have to give that statement of inventory, you better be sure that there is a consumption record for an inventory. In most cases of our clients, they record purchases, and then you will have closing stock, and then you will have sales, and the balancing figure will be consumption. Now today, is he consuming, or is he scrapping and selling separately, or there is a transaction escaping assessment? You don't know. So those foundations of controls are equally for a large non-corporate as they are relevant to a corporate. As I speak, I'll tell you a couple of other things why I think this entire landscape of auditing is also changing. Don't know whether you know, the RBI in a certain circular, just famously known as the February 7th, 2018 circular, said all borrowers above 5 crores have to be reported to CRILC, which is the Central Lending Repository. And they said if there is a default of 1 day, you need to mark it SMA 0. A default, otherwise 31 days becomes SMA 1, 2, 3 and then your NPA. But today everybody is very focused on actually looking at the financial statements and the borrowers very closely. And today I think I read in the Economic Times they are planning to throw open this CRILC to everybody, to all lenders, not just the financial institutions, bankers. RBI wants to open it out. I think previously if you signed a balance sheet, nobody would ask you anything about it because it will go into NPA, dead and gone, and then the bank also does very little tracking on an NPA account. They only say suit filed accounts. Suit filed accounts are actually live, but they don't even collect balance sheets for those accounts and nobody really knows what's happening, and that's a big part in itself. I think today there is a very high chance that your work will come up for a very early review. So the yardstick to apply here would be, is my client a public interest entity? Meaning, does he even have a crore of bank borrowings or public money that he is using? Then you have to be very careful in your audit. Non-public entities are those that are husband and wife companies, etc. But even there, you must have again read this, there are about, out of the 11 lakh companies, the MCA has written off about 1.5 lakh companies, calling them to be dormant or inactive, and they've been struck off. All these effectively have been shell companies. So while your client might be a very innocent entity, the source of his funds could be a company where there is a banker involved. So please understand these dynamics when you do an audit. So today it comes to whose prerogative or whose responsibility is corporate governance. Is it the board? Is it the senior management, the middle management, the operating management? Is it the internal audit teams? Is it the statutory auditor? It's now become all of the above. And another challenge our profession has been facing is one of perception. Nobody really seems to understand that audit is done in a framework. We audit according to a certain framework, so we are constrained by that framework. Of course, we can apply and we must apply common sense to that framework. But today I think there's a larger issue of where you have to manage perception more than anything else. Your lines of this framework tend to get blurred. Again, it's a very conscious call. If you want to be in a statutory audit domain, you must be willing to rise up to that perception and manage it. And nothing is very difficult. If you still go back and apply what you learnt in your articles days, I think all of us should be able to crack it. I like this very much. It's the control onion, and it's very important for your risk-based audits. Just to appreciate how an organization functions, your internal controls and your external controls, management oversight is the core. Which is why when you do a risk-based internal audit, you actually go right up to the top and see what is the management oversight over a function. So if I'm talking of procurement, do they have a dashboard? Do they track it? Do they monitor it? It's very important. Self-assessment, quality assurance reviews, peer reviews, internal audit, statutory audit and regulators. So if you look at it, the color will be very intense in the center, because what we say in our financial statements. The financial statements are the primary responsibility of the management, and as an auditor you only express an opinion. So the core task of managing the organization, its controls, its risks, its opportunities, and to deliver results is that of the management. Coming from corporate governance, one of the pillars of corporate governance is internal control. What is it? It's the process effected by an entity's board of directors to provide reasonable assurance in the accomplishment of objectives, efficient and effective operations, financial reporting, compliance with laws and regulations. You'll find that a lot of this has now been enshrined in your Companies Act, and in fact in the director's responsibility statement there is a line. It says that directors have devised proper systems and policies to ensure compliance with all applicable laws and regulations. So somewhere along the line, everything has got enshrined. Your own audit reporting talks of compliance with your financial reporting framework. It says it complies with the accounting standards. Internal audit. So since my topic for the day is internal audit, so you sort of downstream and you come to internal audit. This is one of the best definitions. It's the IIS. It's an independent, objective assurance and consulting activity that adds value and improves an organization's operations. It helps to bring about a systematic, disciplined approach to evaluating and improving the effectiveness of risk management, control and governance processes. Here I'd like to just step one back. So there's something like a waterfall of sorts. No, not exactly a waterfall, but a structure. See, right at the top of an organization, you will have ERM, the Enterprise Risk Management. And you don't have to think that it's only true of listed companies, but there are several listed companies which don't have it. So, but everybody is supposed to have this because you operate as a going concern and you expect management to look forward over the next 5-10 years period. So what does ERM talk about? It talks about risks and opportunities. And within the risk, you have strategic risks and operations risks. So let me give you a small example. Suppose you're auditing a paper company. So whether I'll get wood pulp at these prices over a sustained period of time is a strategic risk. Will paper prices hold is a strategic risk. Will there be continuing demand for paper could be a strategic risk. Will I get labor supply at all over a period of time if I'm in a plantation company? It's a strategic risk because all the plantation workers would obviously want to migrate and have their children educated elsewhere. So those are strategic risks and those really don't form the core of your internal audit process. Then you have operating risks. So in those risks again there are two categories of risks. Those that impact financial reporting and those that don't impact financial reporting. Of course there are different ways of looking at these risks which we'll come to. But the reason why I'm specifically saying this is because as an auditor you're also doing the echo for certification. Correct? You provide your certificate saying that my internal financial controls are operating effectively. So that IFC risk is part of your operating risks and the next one is the other risks. I'll give you an example. I have non-saleable inventory, non-moving inventory. That's an ICFR risk. The risk which is not an ICFR risk is a stock out. Today I don't have enough stock to run my plant. So, but that risk will get covered in internal audit because it's about efficiency and effectiveness of operations. Which is why today, if you get an engagement to do an ICFR, you basically map out all the risks because it's easier that way, and then you only index the ICFR risks and work on them for your financial statement certification. So broadly speaking, you had ERM, you had opportunities, you had risks. In the risks you have financial reporting risks and other risks. And so in internal audit, you will look at the whole risk which is non-strategic largely. Although as an internal auditor, sometimes you might be called to look at strategic risks as well. So when you're talking of internal audit, again it's extremely important to just appreciate what are your risk families. So this is just one way of stratifying to appreciate whether what risk family will be there in what financial statement component. It's very similar to your assertions, right? You have this existence, rights and obligations, occurrence, completeness, valuation. All these are your assertions and some assertions will attach themselves to some financial statement components. So for fixed assets, for example, rights and obligations is very important. It's not just enough if the land is there in the balance sheet of the company, but the land must belong to the company per the title deed. So similarly, you have risk families which are largely categorized as legal or compliance risks, financial reporting risks, staffing or organization risks, credit risks, insurance risk, sovereign or cross-border risk, market risk, operational risk, system and technology risk, which is very large, strategic and franchisee risk. Now actually, just again in terms of a very small digression, from whatever I have seen, today the biggest risk that is sort of before you as an auditor is management override of control. Everywhere you see in all these corporate failures, the baseline transactions have all been correctly processed. It's one large JV somewhere, one rogue transaction, one rogue approval, one case where a board says, oh yeah, employee trust we'll create and we'll, like it happened in ILFS. Or one large set of investments, they said, yeah, 300 crores is recoverable, let's say from Metas or whoever. So those kind of, or a case of 5,000 crores of a bank deposit which didn't really exist in the books. These are management overrides of controls. And those are the ones that you need to watch out for, whether you're doing a statutory audit or an internal audit, and doesn't matter the size of the organization, it needs to be watched out for. And the only thing you will look for is the business itself. If the business is not doing well, then there is a very high chance of a management override of control. Coming to risk-based audit, it's actually very, very simple. So you just view it like, an interrelated set of elements, like your metadata. So all independent data will talk to each other in terms of metadata to give you a risk-based audit perspective. So and the entire concept of risk-based internal audit is filled in just these 4 boxes. You just visualize 4 axes, X, Y, Z and A. Now in your first axis you have your financial statement component, fixed assets. So that's how you build a risk-based internal audit process. So let's start right from the top, it's fixed assets. Under fixed assets, you have activities and processes. What are your processes in fixed assets? It's asset addition, deletion, depreciation, idle asset, asset movements, physical verification, impairment. What else? So these are your activities and processes. Now on each of these activities and processes, I identify risks which could be related to a family. For example, I could have bought a fixed asset from abroad, so I could have an exchange risk on it. I could have bought fixed assets under EPCG, so there is a compliance risk on this. I have to do my export obligation. Very simply, my fixed asset, I have a fundamental risk, it can get lost. How do I ensure it doesn't get lost? I have a process of tagging, physical verification. I could have a risk on depreciation, right? I might just not compute it properly. I know a lot of companies which have still not migrated to the Companies Act 2013 depreciation. They're still on the old one and they still use their tax audit formats to pull in their depreciation. Some of this is, needs to be sort of, but however it may not be material, but these are all baseline compliance issues that you need to work around with. So that's your second part. So this is pretty much, and one thing about this risk-based audit is you just have to imagine you're the owner and you have to say, how can I lose money? And then everything just falls in place. And you start thinking, because if it's your house, you want to lock this door, lock the door, make sure you put it in a safe deposit locker, everything. And then finally you lose the key, that's a different issue. But then more or less, if you think very proprietarily, then your audit is just much better. So for example, today if I'm sitting on 150 crores of receivable, I will say, what if this is my receivable money? What would I do? Would I not go to the customer or try and reach out to the customer and say, okay, is this money real? Why are you not paying? And today as an auditor, I'm allowed to circularize a balance. I'm even allowed to talk to the customer. What is wrong? Why would I not do it? Would I just give a qualification in my audit report that says balance confirmations could not be obtained? Especially if top 5 customers account for 80% by value. See, these are the questions that the government is asking today. If it was so obvious, could you not have done that little stretch? So the third part is control design. So I have a very small example for it. My daughter goes to class 10. So we know we need a maths tuition. So I have to put in place a maths tuition, and that's control design. Because I know there is a risk of bad performance, so I put in a maths tuition. Operating effectiveness is, she went to the class yesterday and she said it's not there and she came back. So, and it really happened. So we knew there was an operating effectiveness failure, because whether she's going to the class or not is the second part. So this is exactly what control design and operating effectiveness is all about. So you have a client, let's say 100 crores turnover, maintained in Tally. I have a control design issue. And again, I'm not particularly, picking on any software, but I find it extremely difficult to believe that a client with a very large turnover on Tally would pass the internal financial controls of a financial reporting test. How can any software where you can delete something, how can it even pass your test of IFC? And why are we not taking it a little seriously is something also that I'd like all of us to think about. It's so easy, and most clients don't enable audit logs. So do we want to go back to these things? I think it's important. Because again, please remember this, if everything is hunky-dory, there are no questions asked. But if your client has a bank borrowing, then he jolly well sort of come in with a reasonably good accounting package, or in a lot of times you don't find any of these vouchers getting printed. I've seen cases where they say, no, we don't print invoices. We just send one to the customer and we are done. And there's just no trail. There are clients who don't print any JV, never printed, never signed, no consumption records, no fixed asset register, and yet we believe the financial statements are true and fair. I think some of this, instead of just looking at like this boilerplate thing, last year's ICFR you copy, paste and you sign, I think it's high time we actually opened our eyes and thought about it. Because I think the risk that you're taking by signing something like this in this particular climatic condition in India is not really a wise idea. And I'm sorry if I'm sounding a little scary, because I genuinely believe we are the last bastion of trust for this country, and if you fail, then the whole system actually virtually collapses. The fourth part is operating differently. So the entire concept of RBIA or any risk-based audit resides within these four boxes. Right now I'm just going to move straight into our procurement, but before that maybe we can do some risk imagination exercise, just to sort of lighten up. So let's assume it's my payroll cycle. So maybe we can make this participative. So if my first box here on the top is risk-based internal audit payroll, what would your activities and processes be? In any order. In payroll, what all happens? Excellent. So before attendance, can we come about it slightly logically?
List of employees.
Okay. But in terms of a process?
Employee addition.
Excellent. So you have an employee addition. Now would you like to stretch your mind a little more and say what before employee addition?
Terms of employment.
Okay, that would all come under addition, joining. But before employee joining? Recruitment. Excellent. So what can, so then you have a process of, can I say, okay, recruitment, selection is a process. So recruitment and selection. Yeah, training would be more operational. So I would not, as a financial auditor or an internal auditor, I may not really go into training. Unless there is an SOP that says training is critical for something else. So for certain classes of fintech companies, your RBI training is compulsory. So that might come under your CLAR standard, which is compliance with laws and regulations. Yeah, so we spoke about recruitment. Now why is recruitment very important? Because you can have your HR head operating only with a particular vendor from whom he sources all resumes. There could be a case where the user will suggest an employee, a new employee to join, and the user himself will take the interview. So some of these you will cover in your internal audit. So I think it's important. So you start with recruitment. In fact, every organization must have an open system for receiving resumes. How do I know I'm not dropping something on the floor? How do I know I'm picking everybody who's coming my way? Large organizations place very high emphasis on these kind of aspects. It's like customer order. If the customer gives you an order, should you not record it somewhere? How many organizations monitor order failures? In FMCGs, it's called OTIF, on time in full. So they'll say if the customer has placed an order, he would have placed an order for 10 SKUs. He'll say RIN 100 grams, this, and it's called an SKU. They will measure something called as a line fill and a case fill. Line fill means he's asked for 10 lines and I was able to service 9. So my line fill is 90% from a depot. And a case fill, he totally asked me for 1200 cases. I was able to give him only 900 cases. So it's 9 by 12 is my case fill. These aspects are critical in an internal audit. And almost invariably the board likes aspects like this because this is exactly where the money is. Why did my stock not connect to the depot? Why was I not able to sell? And some of these are actually very logical. If you go through their own internal processes, you come up with this. So yeah, so you have recruitment, you have addition of employees, you have terminations, retirements of employees, you have attendance. Then what else would you have? Payroll processing. The core system that generates the payroll. Payments to employees, very high risk. Can I create more than one bank account for the same employee and pay? Is my bank account of the employee the same as a vendor bank account number? Huge amount of cases. However, now the employees have got smarter, so you don't find that. But some of this happens. Even if you have a client who has 100, 200 employees, these are things you must watch out for. Similarly, assets with employees. There are many cases where employees are given assets and nobody is tracking it. When he quits the company, there's just no final settlement form. Similarly, when on termination or retirement, you have a final settlement. Normally, an employee who has quit his job will never be settled in that payroll. It will be held. So these are aspects that you would come in your activities and processes. And risk families, it would cover your operations risk. It would cover compliance risks. Why? Because I have PF, I have ESI, I have your accounting standard compliance on retirement benefits, you have gratuity, and a whole stream of statutory compliances. So your risk families, control design on all these aspects, and operating effectiveness. So somebody can you tell me one control design in any process on payroll? One control design. Employee ID. It's very fundamental but very important. Similarly, if you have a factory and I have a time booking system, my total time booked in days should tally with the total payroll process days. That's a simple control. Similarly, who conducts the interview is a control. Who signs the appointment letter is a control. The delegation of authority should say that all appointment letters have to be signed by both the head of the HR and, let's say, the head of finance, and it should be as per the manpower budget. Our friend keeps on issuing appointment letters where I don't need so many people. These are very, it's called a SPOF, a single point of failure, because if it fails there. Similarly, when you do a risk-based internal audit, you think one back. You say, today does my company even have a manpower capacity plan? Do I need to get 1,000 contract laborers in? What is the work that they are doing? When did I do my last time and motion study? So some of these as you speak. And another thing is, I think somewhere along the line, all our internal audits have become very financial statement focused and we are a little embarrassed to suggest this. But in my experience, I found that this is what the managements are looking for. You tell them, look, because sometimes, when you say, oh, there is no manpower capacity plan, we think it's a very trivial observation. You'll be very surprised. I think it's the largest observation. You can say that the time and motion study in this factory has not been done for the last 5 years. Because a lot of companies, for example, in Andhra Pradesh, you have these APPC rates, Andhra Pradesh rates, piece rates for various jobs, painting. People have adopted the same APCC rates endlessly. But today, for cleaning, I have bought my machine already. So previously, when I did my APPC rates in 2012, one worker could clean only so much of the shop floor. But today, he runs on that machinery which cleans much faster. Have I factored in those? I might not have factored in. All these are relevant in an internal audit. And you take one instance and do a time and motion study and prove it, and then you will see that the client's perception of your fee will undergo a significant change. So, we move to procurement.
Excuse me.
Yeah.
One of the main problems, in the payroll processing, generally it is done because there are good controls. But ghost employee,
Correct.
how do you find a ghost employee in an audit?
So the only way you can find a ghost employee is you first of all have to ensure that your attendance. So the way you do a payroll audit for ghost employees, first of all, you have to touch a file for every employee, and the sampling doesn't help. So if I have a client who's got 500 employees, I will tell him, please bring me all the 500 files first. I need to have a file, I need to have a photograph, and I need to know where he is connected to, which department. And there I will not do a detailed file audit there. I will only say, okay, employee number 10031 available, 32 available. You will find your ghost coming out of there, first of all. Secondly, your time booking. See, they'll say, oh, we are on biometric. A lot of cases, your biometric will not tally to your payroll. So that's the second control. The third thing you do is you go and visit the factory, and as and when somebody is swiping in, you take 2-3 days, you just record it and keep it and see what they are processing as at the month end. This is all you can do for ghost. But ghost is the most easy to track actually. No? I have an employee ID and you do a roll call. I can say as
If the number of employees are quite many, that's why we have a problem. If it is 100, 200 may not be a problem. We are talking about...
But you will have a time sheeting software then.
No, time also, maybe certain employees they might dispense with. So you might find...
That they are not allowed to dispense. See, if the dispensation is happening for let's say 100 or 200 employees, you have a problem. If it's for 1 or 2 employees, your CEO or something like that, then it's fine. But largely, if it's a large organization, you have another advantage. You can dump all your data into Excel and analyze. In fact, you can see how, you can take it across months and make a pivot and say which employee existed in which month. And if you see suddenly in 1 month 300 have joined, then there's larger scope for it to be a ghost. But I think people have found smarter ways to manipulate. They don't do ghost employees anymore. But in a lot of the second level SME entities, in order to book costs, it might be the simplest because it does not attract GST. Today, if I do my sales inflation, my logical thing would have been to inflate purchases, but if I inflate purchases, I will have a GST issue. So what do? I only have to, if I book expense, I will have a TDS issue. So I book 20,000 rupees into 12, 2,40,000 rupee value employees, I pump in 100. It will not touch any of my radars. I can issue check payments, but then how I will manage that cash flow will also be a problem. But in fact, you raised a very valid point. In fact, in all our balance sheets this year, payroll might be the biggest risk. So now you've been engaged to perform a risk-based internal audit to the procurement function of a large factory of a client or a client with a very large factory operation. The key terms of reference are to examine the present procure-to-pay environment. So the current term that they use, and even when you quote, you must use this, is procure-to-pay, order-to-cash, hire-to-retire, and assets. And your treasury operations if you want to keep it separately. So this is the cluster in which you will do an internal audit. And in procure-to-pay, you will do everything. You will do procurement of goods, procurement of services, works contracts, which are combination of goods and services, and the works. Examine the present P2P environment, existing preventive and detective controls to mitigate frauds and errors, identify potential fraud risk and other risk vulnerabilities through an effective analytics, internal audit and evaluation process. So, the first thing is to imagine the landscape in whatever you do. Like in payroll, we imagine the landscape. The first thing is to imagine a procurement landscape. And at this point in time, you actually detach yourself from the client. So don't go and ask him, what do you have? You build your own mental framework, and this is a standard framework. First is empanelment, vendor empanelment. See, your biggest failures happen there. Contracts given to employees' brother-in-law. And it has been given for the last 25 years. So vendor's brother-in-law is not a civil engineer, but he still executes civil contracts. Why should I go to him? So vendor empanelment. The second is master data. What is the quality of master data in my system? Again, for those clients of yours who are large, who are in tally, I must tell you, the data quality is very bad. You will have 2 accounts for the same vendor. So I will pay my advance in one account and I will do my material receipt in one account. Both will be hanging and somebody will actually make a payment also from the second account into the second account. So one account will become 0 and one will be a vendor advance. So you have to be very careful on how your master data is controlled. And today if you have a client in tally whose master is not complete, it's a risk. Somebody quits and goes, I don't even know my customer's phone number. How do I run my company? And some of these I think also need education processes having to be independent of people. And that's what your risk-based internal audit does. Third is limits of authority. Again, I think it's also relevant for small organizations because the proprietor can't sign everything. You have to tell him some level, have some kind of detachment. I wouldn't say so much about a proprietor, but a large partnership, yes. Do they have at least somebody who's reviewed something before the partner signs the check? In a lot of cases, they don't. In a very large organization, of course, there'll be a very structured DOA. And this DOA, I'll go back in bigger in a framework. Even for a small private limited company, let's say 20-30 crores, you need to have a DOA. You need to know who's empowered to raise purchase orders, up to what limit. And you must also explain to your client that it's important to manage by exception. He can't keep signing every 100 rupee, 200 rupee voucher, in which case he's lost track of the big elements. The fourth is need to request. So imagine a circumstance, I didn't even need it. So just like that, there is some 1,000 tons in the port. So he says, can you take the 1,000 tons? The purchase manager says, yes, okay, I'll take the 1,000 tons. Why should I take the 1,000 tons? I've seen cases where there will be a central store, an engineering store. They'll just keep on sending to the child factories only to create the aging to be new. A simpler example is like this. I have a debtor's ledger. I will pass a credit note and debit note on the same day. Your tally's aging will change. Because the credit note virtually zeroizes my old invoice, which is 1 year old, and my debit note reinstates it today. Your aging is completely skewed. I'll tell you another way people age. For every account, let's say there's an account called Mr. Ramanujam, who's a supplier. I will create Ramanujam 2 and I will transfer the balance from Ramanujam to Ramanujam 2. Ramanujam 2 will show it as a 1 day outstanding. For those of you who are doing the stock and book debts audits of banks, this is something you must watch out for. Highly, highly likely. And these actually, so there are two things. First of all, how many of us go look at the aging? So if you're looking at the aging, in fact, I have seen cases of stock audit reports where identical stocks have been given every successive month, and I don't know why we did not find it. So some of these things we need to be a little careful. Because another thing is, as I told you, finally today they say, okay, what was the auditor doing? Even if you've done a great job, they ask you that. So the need to request requisitions, there has to be a system. So somebody must ask for it, somebody must approve that asking, and somebody must give it. See, today whether you like it or not, you are certifying internal financial controls. So there is no dispensation for certain most companies, and the thresholds are very small. So you have to be a little careful on this. Then you come to quote to award. So that is the most critical part where an organization can suffer a value loss. So again you have an issue here, because is my value loss, it's most certainly an internal audit scope, but is it important for my statutory audit? I would think yes, because your ICFR definition also includes efficiency and effectiveness. So somewhere along the line, but unless, so see, otherwise why would they insist on related party transactions? Why should RPTs go through a separate sequence of approval? Because there could be value losses. So quote to award, then the aspect of raising a purchase order. So within a purchase order, a lot of our clients will be having purchase order numbers separately, and then they'll say, oh madam, that is not a purchase order, that is a contract. I till date don't understand how you can have a PO or a contract. It should at best be a continuous running PO supported by a child contract. So suppose I have a vendor who's much bigger than me, and he says, no, I will sign it only in my format. It will still be a purchase order that I am raising on him, backed by a slightly different contract format. Then fixed price agreements. A lot of times these have, you agree to purchase at a fixed price over a period of time, scheduling it. How are these controlled, tracked? Do they even have elementary mechanisms to do it? See, today even if you take a small steel company, let's say 200 crores, there's so much of pre-buying that they do. Similarly, there are, there'll be purchase orders that you would have placed now receiving over the next 7-8 months. How do I ensure that these are all tracked properly? So, PO amendments. If I amend the purchase order, and again I come back to it, please don't look at this in the context of a large company. No, even a small company. Can my purchase manager issue an amendment? Ideally, no. A person who's raised the PO cannot amend the PO. It has to go to the next higher level. A receipt certification, there is quantity and quality. Then there are rejections, supplier invoicement, payments, MIS and review process. Most important, which is not here, is supplier reconciliations. How often do you reconcile your suppliers? And why should suppliers not be reconciled? If I was a statutory auditor, I will go to my client and say, sir, unless your top 10 suppliers, you get me a confirmation. And you start in April now for next March. When you do it slowly, tell me. While supplier, I'm broadly okay with. The customer, I will insist. Because if the customer is not intending to pay, and I am not intending to go legal as a company, then my chances of recovery are very low. That's the other question we must ask.
No problem. You can get it from a vendor, but from customer you will not.
Customer, you
because that fellow will say, for a vendor you can hold the payment and you can ask him to get it. With a customer you will find it extremely.
In which case you will need to perform additional especially where there are large amounts, please be very careful. Because a lot of these banks lend on stock and book debts. So if you don't have your receivables, then the whole lender security is also impaired.
Is your way be different if it is not funded by the bank?
I would be less harassed. That's why I had made a difference. You have to distinguish your client as a public interest entity or otherwise. If he's got 500 laborers, he's a public interest entity. There's a certain, even if there are no bank borrowings. So it's the largeness of the enterprise plus a funding that makes a difference. So while on one axis you mount all this, on the other axis you look at what controls you have. Enterprise-wide policy. Do I have an SOP? Why should a 10 crore client not have an SOP? So, organization chart, delegation of authority, segregation of duties. So I'll leave with the DOA and all that. Fundamentally, I should at least have a segregation. The same storekeeper calls everybody. It doesn't work. Risk assessment and SOPs, IT platform. Then you have data mining, analytics, and transaction testing. So the first three parts are your control design framework. It basically tells you, look, I have a control design. My daughter will go to a tuition class. Operating effectiveness is I pull out data and I check. Admittedly, the RBIA or even a risk-based audit, you do it for a company or an entity which has some scale, not a very, very small entity. Unless, as I explained to you, they have very complex transactions. Let's assume a company, a partnership firm is dealing in derivatives. I will have to do a risk-based audit. I have to appreciate the risk because it's not just an issue of signing a couple of things. So, this is how you basically go through the entire framework. So, for example, delegation of authority. Even if it's a private limited company, again, a lot of these things are relevant even for your internal financial controls in your statutory audits. Because you're there, you do two things, right? Entity level assessment and process level assessment. So all this is at an entity level. So do I have an existence of a DOA as approved by the board? I don't know how many of you read those standards on auditing, which speak about client acceptance formalities. You know, you have those processes to be followed. Has there been exit of key managerial personnel? A lot of questions are there in those checklists, and I think those essays have to be really applied, both for new clients as well as for existing clients. There is a client continuance checklist that you build. IT system. In a lot of cases I found that, you know, there will be one physical DOA that will say this has to be approved by a, let's say, a senior general manager. But in my IT system, it will be configured to an assistant manager. Straight away, the whole control has failed, right? Because you're saying this is the man who or the woman who can approve this level of spending. So that is the same thing that has to be configured in an IT system. A signed DOA document. Again, a lot of organizations now say, oh, madam, it's there on the mail. You said, show me your freight contract, sourcing. How did you select your freight vendor? It's all in the mail. It's there in Lotus Notes. So give me the Lotus Notes. No, it is not done by me, it is by the earlier person, and it's there in his Lotus Note. No. I think this is something that the board, the audit committee needs to know. That you don't have an audit trail for a sourcing process. It's important. And I think every small failure makes a difference. And that's what I'm trying to tell you. If it is your money, will you be okay if your manager is not able to tell you why he picked a vendor? If the answer is you are going to be unhappy, then it goes into the audit report. If it's a 10,000 rupees spending, I'll tell him, okay, forget it. Don't make this mistake. But if it's value, please evaluate it from a very, very proprietary perspective. The DOA should, as far as possibly, be cross-functional. So today organizations have said finance has to get involved in commercial also. So procurement, everything has to be cross-functional. Temporary delegation should be clearly defined. Cross-functional negotiation teams. So I had mentioned this to you, right? Any purchase order which is getting amended or any contract which is getting amended needs to be approved by the next level of persons. Group level authorizations should also be included in the DOA documents. RPTs, related party transactions. See, again, I have to take you a little bit into this insolvency code. I don't know whether you know, but there are about 12,000 cases which have been filed across the tribunals in the country, including operational creditors. The problem in this insolvency code is even an operational creditor can apply to NCLT for the commencement of insolvency proceedings. So it's nothing but a court administered attempt to resolve a company's problem kind of code. Now, in this, if you look at it, once you go into the insolvency code, there is a responsibility of the RP to do a look back. If you remember the earlier liquidation also, we used to look for preferential transactions, right? Undervalued transactions. I'm the owner of a company and I've given away the property belonging to the company to my wife's brother. It's a 5 crore property, I've given it for 2 crores. It's an undervalued transaction. Or just before this insolvency, I've alienated to my wife. I've done a memorandum of deposit of title deeds to my mother-in-law. It's an alienation. Now the RPs have to look at this. And today, very simply in NCLT, default, if there is a default and there is no dispute, an operational creditor can get admitted. I don't know, out of this 12,000, how many of our clients are actually there in that bucket, but it opens out, and the first thing the RP looks for is, an audited balance sheet. And says, oh, why is it looking very different? DOA is to include relevant clauses in relation to non-splitting. This is very common in a lot of enterprises. Instead of if I raise one purchase order for 50 lakhs, somebody has to sign. So I will split it into 2 purchase orders. Yesterday one and today one. Or today itself 2, the system will not track it. So the point I'm trying to make is, in a risk-based audit or even in an internal audit, your mind should always look for exceptions. Somebody will say, oh, I will bring materials to the gate. It will get inverted. And the article clerk will beautifully document the process. But what you need to know is what happens if I reject. How is it going back? Is it going out? How does that loop complete by itself? Similarly here, maintenance of supporting document, and of course there is a common rule, the delegatee should not be the beneficiary of the transaction. DOA should define, and today when an organization gives a DOA, you will have to also approve what is my standard sale invoice format, what is my purchase invoice format. See, these are again small errors which would get you into GST issues. Am I compliant? So today the point is, just look at all those basic things, you will find a lot of issues. For example, I know of a client who admitted to an arbitration in Mumbai without even knowing that the clause was Mumbai. So I said, why did you even agree to it? So he said, we just didn't see. And that was a classic case where there was a contract and there was a purchase order. So there was an issue. And DOA should be signed. So if any of us is auditing slightly larger companies, your DOAs have to be signed. Come to vendor empanelment. An organization should have an open culture of inviting suppliers. So a lot of these youngsters, startups come up and pre-audit and evaluation processes. Again, my experience with vendor masters has been that they're generally blank. I've known organizations awarding contracts and we've gone and checked that person is not there in that address. Somebody might say, oh, but Priya, what if he's not there in the address, he's still building this building. I've paid only on this building. My point is, if the building fails, can you go find him in that place? You can't. I mean, that's scary. So just like you have shell companies in MCA, you will have shell vendors, which need to be, sort of watched out for. And the more your client is in a remote area, a Moffisil kind of thing, the more are the chances of such kind of fictitious vendors or shell companies. Supply application forms. So today, look at, for example, can you go get a passport without giving any document? Can you go get a bank loan without getting a document? In fact, a friend of mine was telling me, at the rate at which these bank loans have got defaulted, they said maybe they should disburse loans through ATMs, no questions asked. At least you don't have banking overheads. Because credit appraisals, everything seems to have really taken a very, very harsh beating. So that's the same yardstick I'll apply. If the man wants to supply to me, if the vendor wants to supply to me, then I must have a track record. I must have something. I must have a piece of paper to establish his genuineness. Empanelment and supplier inclusions to be done with finance and supply chain approvals in writing. Again, this might not be very relevant for small enterprises, but for large enterprises, you must have some stratification of suppliers. Today, the user will decide, okay, I need to do this painting. He will identify the vendor, he will send the quote. But finance finally will sign the purchase order. Today we ask finance, do you even know who are all the painting vendors in this particular place in West Bengal? They say, no, we don't know. So they say, why don't you configure that in the master so you can at least go and send out quotes to somebody. So these are things that you look for in a risk-based audit, because today here you want to get best value for money. Obviously, right? I'm spending 100 rupees, I want the best quality. See, another question that keeps popping up is, today everything is very clearly defined businesses and everybody wants business. So when you find a client, you find a clear absence of OEMs. I've got this huge factory that keeps someone need to get painted because there's a rusting issue or something like that. Why would I not go to an Asian Paints, an Aerolac or somebody and fix up an OEM? Why would I still work with, of course, I mean they would work with an authorized dealer who will be a person locally, but these are questions that you need to ask. What is my OEM sourcing? So, supplier category definitions, blacklisted suppliers. Very interestingly, I was just looking at Tamil Nadu government, one of the C&AG audit reports of 2017. And there was a prominent observation that said some drug corporation of Tamil Nadu had picked up 1,600 expired drugs had made their way inside the company. So they had actually listed it. They said 1,600 instances of expired drugs which have made it. Similarly, that CAG report spoke of procurements which were continuing from blacklisted vendors. These are the things I don't understand. If you have something like a slightly larger ERP or something like that, you can checkbox a vendor. Can I make a vendor inactive in Tally? Is it possible? Then how do you prevent transactions with such vendors? It's finally just one man who has to decide. He might not even remember. And where is it all this documented? Nowhere. So accuracy of master data with reference to base documents. So then we come to master data. I think, however, so what would you think is important in master data? Additions, deletions have to be controlled. Again, how many of us work with clients who are largely on Tally? Nobody? Tally? In which case, how are you going to build all this? And in which case, why are you saying that ICFR is good?
See, I'll tell you one thing. Even the other ERPs, not every ERP is good, excepting unless you go to SAP or SAP or Oracle. We don't think anything else is not good. They do implement ERPs, but in fact, in most of them, it's below par.
In which case, do they have offline controls? How do you build offline controls? Do I at least check it for the top 5 things that these are okay? Only in cases where you are certifying that ICFR.
But in most cases, it happens. In most cases, we have to certify.
So that's a huge challenge. How do you handle accounting controls and Tally? So for example, in Tally, will your Tally pass your ITGC test? So my objective is not to assail an accounting platform, but all I'm trying to say is, how will you as an auditor ensure that he is not doing this? In which case, you please ask him for the JV register. At least before the conclusion of the audit, please ask your MD to sign all the JVs and put it there. Fair enough. So at least you know the transaction is authorized. And if it's Tally, I would strongly recommend 100% printing of vouchers. You have to cite every single voucher.
Nowadays, the printing is so bad. It doesn't happen at all.
I can give you the example of India's possibly #1 or #2 FMCG. Even today, they print, it's ITC actually, they print the voucher, they print all the supportings to the voucher, and the person who signs the check signs every page of that voucher. And that's the kind of discipline that they maintain, which I think is very good, because they think not only should he sign the check, he should also cognize. I thought that is a great control practice. So it's no reason why somebody in a smaller organization should not do it. After all, it's their money. And I think these as auditors we should insist. No?
If you look audit trail in Tally, the Tally itself you can customize.
Most clients don't keep audit logs at all, sir. Because if you keep audit log, you can't delete, no? And especially if they have deleted, are you okay with that deletion?
In Tally is available, approval is available, and voucher verification is available, everything is available. Only you have to customize, you have to insist. That's what my opinion. See, you have to in future, keeping physical document is difficult.
No, sir. We have to keep scanned images, attach
Yes,
them.
scan it and keep it, that's different, but we can try to make it computerized. We insist on the system.
Yes.
System
So,
is important.
my only concern is if you're working with something that's weak, then it's better to have a paper trail.
In fact, the problem in scanned documents is we do not know whether it is original or duplicate.
Absolutely.
We have a major problem.
Especially inventory, issues to production, for example. I can't see anybody having a paper. It's always month-end physical verification and one adjustment. Again, I'm just leaving a couple of thoughts because I'm saying, but if you are doing somebody who's a 30-40 crore turnover, 15-20 crore bank loan, then kindly, and if he's tending to NPA, please be even more careful. So, and currently I think it's a pretty depressed kind of thing. A lot of people are going bust. So, master data completeness to be ensured, active vendor lists to be maintained. So another thing is today who enters tally for a vendor booking. So again I do realize at some level that your organization may not have enough number of people to do all this. Which is why when you're talking of RBI, you're talking of a certain scale in an organization. So this segregation of duties has to be strong. Again it comes back to this. If it's not there, then how are you? So I think the until this IFCR reporting came, we were not so, we needn't have been so careful. But now with this IFCR reporting coming in, some baseline top 20 checks at least you need to ensure. So, because one thing you can do is, if you don't have an IT control, okay, you can say I will do sampling, I will do 70% sampling and you're absolved, let's say. Say I've done a transaction audit, but how will you take it for your, this we need to see. Or you have to just disclaim and say that this is the scale of operation, so we've not tested IFC, whatever you want to write, you write in that report. Please don't say everything is fine when it is not. So, if non-stock items and services account for a significant portion, then they need to be codified. Lots of organizations will say, oh madam, that is non-stock, which means it will go directly into consumption. Please check for such non-stock items. PO types to be maintained in IT system. Ideally, I don't know whether Tally also I think supports it. You can have a separate purchase order series for materials, for labor, for capital, if possible. Units of measure. Again, in a manufacturing company, I've seen a lot of errors on this. For the same item, they will have two codes, and one will be in kilos and one will be in tons or something like that, and the payments will be wrongly made. So these are small things that you need to be sure. Audit logs of changes. Ideally, how many of us have seen audit logs in Tally? I have not seen a single case where I've seen an audit log. Has anybody seen? Does any of your clients have an audit log? No? Maybe worth examining. Maybe we should insist on audit logs. But the only thing is, if there's an audit log, you can't change the cash balance. So, because if he's changing the cash balance, then you can't really agree to it. Similarly, quality parameters. Another thing I've also observed is how many of us have clients or on what they call as homegrown ERPs? Quite a few. Right? Now these homegrown ERPs are capable of doing a lot of things, but they don't use it. I've seen clients who moved from Tally to, let's say, Zoho. They would never use Zoho's functionality. They will treat Zoho like another Tally. So you really don't imbibe those control features. That's something that you might want to insist on for clients who are on. And I think eventually moving to a good automated system is part of growth life cycle that you as an auditor may want to insist on. So, auto posting accounts, again, very technical. Contract formats, I think this is very important, even especially for MSMEs. They just don't know what they are signing. I think it's important for them to appreciate what, and somehow I think there's this reluctance to, people just sign whatever is offered to them. Even some of us, sometimes when my client sends a contract, he's saying unlimited damages for some small breach. So we actually rectify it and say, this will be restricted to the fee paid. So if you want, you please take this feedback and leave us because there's no intent. But I've seen a lot of cases where you're very enthusiastic and you just sign on the dotted line. So I think contracts are very important. Similarly, how many of our clients have a contract register? How do you identify liability? Are they serially controlled? These are very important aspects. How do you know your client has accounted for every purchase order? So even a very simple small operation should have a running serial number. We've seen a client for some 30-40 crores EPC, they don't have a PO serially numbered. They say only for some things we raise a PO, for some things we don't raise a PO. So some organizations come very clearly, and I think all organizations need to have a simple accounting standards and processes document. Just 10-20 pages is enough. It should say any item above 25,000 has to have a PO. Above 25,000 to 1 lakh, you can go for single sourcing also. Above 1 lakh, you have to get 3 quotes. Above 5 lakhs, you need to get, let's say, multiple quotes or whatever. These baseline, somebody has to define and put it in writing. So that's important. And so then you know, if it's a payment above 25,000, I need to have a PO. Terms and conditions acknowledged by vendor. In a lot of cases, the contracts are not signed by both parties. So legal enforceability is a big issue. In fact, when these MSMEs ask for money, and then they have these adalats and stuff like that they are set up, a lot of people don't really go back because the documentation is very incomplete. And a lot of them are not going, and in fact, if you have clients who have money to receive, which is undisputed, you must send them an IBC notice. It seems to be working better than the MSME law. Quite a few settlements which are happening on this account. Similarly, general terms and conditions, arbitration clause very important, jurisdiction very important, credit period. Some of these you can actually add value to your client. In a slightly large organization, you should not go with vendor formats. You should go with the format which is internal to you. So your format will say, this is my terms and conditions. So those things you'll have to be fairly clear about. And clauses reflecting less favorable terms than the company standard format should not be agreed without specific highlight. So my arbitration is always Chennai. There's a particular arbitration that says Bombay, I'll have to take it. Similarly, my credit period is 30 days, but that customer wants 45 days. It's a deviation. Somebody has to approve it. Purchase requisitions. So this is what I told you, right? You need to have a start point. Somebody must want it, and somebody must justify why he wants it. And today, when we get into these small internal audits, for example, there's a client who says, okay, you do my internal audit, I'll pay you 3 lakhs per year. We end up actually checking all his bills. Instead of doing that, try and use this format of saying, okay, what are my risks? What did you buy this year? What were your top 10 buys? Should you have bought it at all? Should you have bought it on that date, or could you have postponed it? So how do I drive a client to a negative working capital? I should be smart. That's what most entrepreneurs look for. I should always have a payable and my receivable should be with me. So if my current liabilities exceed my current assets, then I'm on negative working capital. Similarly, so you need to have your reorder levels and things like that, however small. See, if the turnover is 10 crore, then maybe his working capital is X and there is an interest payout of, let's say, 1 crore. If you are able to save 10 lakhs of interest, that's still good enough. So, similarly, again, organizations of scale, this becomes very important. Single supplier, is it okay? Who approves? If I've got only one supplier, then 100% the board should approve. High risk. Pre-buy decisions. I buy steel in advance. I buy this in advance. Why should I buy in advance? Somebody has to approve. So anything which is not a normal transaction needs to go through an approval process. Quote to award, possibly the most important part. I have seen cases where they send out a quote with CC to all suppliers. Similarly, your quotes are sent to fictitious suppliers. Now, there used to be this very interesting thing, whenever you do a purchase audit, you take the quotes, everything will be standard, same Arial 11. He will say purchase manager, and it will not be manager, it will be manger. All of them would have done the same typing error also. And then you will find out and say, oh yeah, okay, this is a purchase fraud. Nowadays, people don't do all that. The purchase department itself gives a standard format. He just signs and puts his chapa and sends it back, so you can't even figure out if it's identical letterheads or anything. You have to be sharp. how do I send out a quote to a ghost supplier? That's the biggest challenge today. So if somebody sends it to a ghost supplier, it's all over. So you might want to encourage your client to say, why are you not doing reverse auctions? Can you do something smarter? So these are fundamental point of failures. Of course, you could also have a situation where the client himself is doing this just to build a 3 quote. So I give a quote to 3 brothers. What's the joy? You know they're all related, cartelization. So this is where your empanelment is very important. I will give a civil work to a person who's got track record in civil. I should not give a civil work to somebody just because he's good in doing civil. So I need to have that internal discipline. So which means I should have independent parameters to evaluate a supplier. For some of you who are also doing some of these C&AG audits, a lot of this will be relevant. So if you're doing, let's say, BSNL or BHEL, BEML, a lot of this will be relevant. Similarly, you should decide how you will, so for example, if it's a 10 crore scrap removal or something, it has to be publicly tendered. So organizations will define how they will do their sourcing. So that's important. Orders to be placed only based on recent quotes. A lot of times when you're doing this audit, they'll give you, 1 year old, 1 quote will be there, 1 quote will be new. These are things that you just pick up over a period of time and you're sharp and you say, okay, why have you not? In fact, the PSUs have very, very strong policies. Whenever you have the time, you should read this. There is something called the Tamil Nadu Tender Transparency Rules. It's very, very good. It tells you how you must procure. And these all evolved because there are lots of World Bank funds for projects, so they decided they had to come up with something. And one of the very good websites I've seen is one of TNPL's. Be very surprised. We would think that, PSU, Tamil Nadu Newsprint, they have a very good website. You just go and look at their processes. I think I would rate it very high. So CSQ. So when you're doing a quote to award process, there has to be a comparative statement of quote. And everybody should have quoted on the same metric, the same baseline. You have to bring it all back to the same thing when you're evaluating. All cases of quote waiver to be evidenced by a justification note. Vendor quotes should be complete for item, price, taxes, lead time, delivery location, validity period. And a PO should be raised after, that's another thing. A lot of clients will say, oh, where is the PO? We raised it after material receipt. So straight away an exception. So non-L1 contracts should be backed by justification notes. So, in fact, you will find a couple of things which will be very interesting in this. When you're doing this procurement process, you will find that I will award it to a contractor called Raja. And whenever I award it to a contractor called Raja, I will always be issuing quotes only to 4 other people. And it will be more or less the same 4. Those could be instances of bid rigging. Of course, all these are very difficult to prove, but if you're able to generally at least sensitize the system, it's worth it. What you can do in those circumstances as an internal auditor is to get one independent quote and see if the prices would have been lower at that point in time. Tender process not followed, tenders received by email, invitation to tender not sent to all vendors. So which is why it's very important for a system to recognize who are all my vendors. So if I'm going to, let's say, tender for a housekeeping service, I must have a huge base of housekeeping vendors I operate with. So those should be flagged in my system. I'll leave this part. Similarly, purchase order creation. So there are controls to create a purchase order. Similarly, you will find several organizations where I'll have an old PO which is pending for 10 rupees. I will create a new PO for 12 rupees. How is that possible? Correct. Where I have an old delivery at a lower price which is pending to me. And some of these, for this, you don't even need to have an ERP or anything. Just look at Tally, you will find errors in this. And here you can actually go and, so the old PO will continue to be open and I'll be buying at a new price. Some of these are very easy if you're using ACL. So if you're using any audit software, then you can extract data and do this. Or you can even do it in Excel. But again, it depends. But some of these may exist in your client, even if they are very small. And see, if you're able to demonstrate to a partnership firm, that you lost 2 lakhs in this and I'm recovering this 2 lakhs for you, then it adds that much more value. Similarly, people split purchase orders just to make sure that, I can get a lower level of approval. Not allowed. I've seen organizations where there are 57,000 purchase orders. So nobody understands why. So we keep telling them, why are you raising so many purchase orders? Why don't you just say I'll share? So you'll find one parent order and then again every month. So you're saying, why are you raising so many? Why don't you just create something called as a scheduling agreement or something like that? Now, I'll also take you to a very manual system where you have a very manual purchase order. This control your client should have. In the reverse of the purchase order, they will document every material receipt and they will have the closing balance of that PO. If that control is not there, then you have a problem. Your client can end up buying more than the PO. Again, I have not seen too many people using a tally PO. If your client has more than 100 lines of stock, then tally is very difficult to handle. Again, it's been a personal experience. It's all over the place. People create material codes for the same thing more than once. So you'll need to work around it. See if you can. But one good thing I think Tally also started accepting data feeds. So you can have a separate inventory module interface to Tally, where a day-end process or something like that you'll have to suggest and do something different. Open PO closure protocols. How long can I keep my PO open? How do I close it? Those are important. Purchase order amendments, always to the next level of authority. Supporting documents for the amendment. I've issued a purchase order at 10 rupees. Can I just go revise it to 12? I can't. I should not. Then it vitiates the sanctity of the purchasing process. So I give it to a supplier at 10 rupees when the next higher supplier was 11 rupees. So I came to him and gave it to him for 10. After 1 month I changed it to 12. Then he's not the L1 anymore. So things like that. Material receipt certification. Again, even if you're doing a small company, which is let's say into chemicals, this quality receipt is a big challenge. A lot of people don't check the quality. In fact, in one particular instance, these chemicals used to come in drums. And the left side of the drum would always be diluted and the right side would be concentrated. And if you're handling any large client, this is very scary. Why do they outsource quality to a person who's a subcontract, vendor employee who gets paid 7,000 rupees a month? What is his incentive to tell me whether the chemical on the right is okay or the left is okay? He will just take some money and do everything. These things you may want to point out. You must have a system of check and balance, surprise checks. Again, the problem is every system can be gamed. How are you effectively able to prevent that gaming is what you're as an internal audit. For example, if you have a large paper company, they do this moisture testing. So if somebody pours a lot of water and gets the old paper, which is going to go to my factory as a pulp, I'll pay by weight. So who will do the moisture testing is done by somebody very low level. So these are risks. So they have something called a furnace test or something, they can put it. So some of this. Again, internal audit is not just about financials. So for example, let's say you're auditing anything, any company, any manufacturing operation. Let's say I have paper, I'm giving you paper because I've seen it. So let's say a paper reel is coming out, or let's say even a product is coming out, and if the product is classified as defective, it goes at a 30% discount. If it is classified as good, it goes at 100 rupees. The person who's sitting there can collude with the vendor and classify a good product as defective and ensure that the defective is sent to that particular vendor of his choice. Huge value loss. Now how can you find this out? You have to find out all products which have been sold at a discount, find out why they have been sold at a discount, who decided that it was bad, what was the process, who signed off that it was bad. You got it right? So there's a 100 rupee product which is falling out of some mill. So if it's called non-conforming, then it goes at 70 rupees. Well, I can sit in a factory and decide that so much is non-conforming. But what's the ultimate test? You will know how much has gone at a discount. Because that product will have a rack rate and it would have been discounted. So if you analyze all the discounts given, you'll come up with something like this. And these are brilliant points of failure. Similarly, one committee would be sitting and noting saying it is good, it is not good. But when I'm entering it into my ERP, I will change and enter. A good I can write is non-good. In fact, I don't recollect this exact incident, but there was some purity meter somewhere. But the purity meter was not interfaced to SAP. So the item will come to the purity meter will say 90. But since it's not interfaced to SAP, in SAP I will go enter as 95. And for this purity meter, there was no manual sign-off. Or I think there was. We compared the printouts from the purity meter with what had gone into SAP. So things like this. And this is exactly where value loss happens. Because I pay a supplier 100 rupees for 100% purity, I'll pay him only 90 rupees for 90% purity. So if he gives me 90% purity and I classify it as 100, I've extra paid my supplier. Similarly with coal. For those of you who've seen some kind of coal, that grading and stuff like that is extremely complex. Similarly, when you're looking at something like an internal audit, you must also look at, I had told you, need for a service. So I have seen situations where a gang would be deployed to handle coal. They'll say we need 60 people, very common in the east of India especially. So you have those Hamali unions and things like that. They'll say we need 60 people. So the contractor will take payment for 60 people. And I will pay every month for 60 people. But if you see attendance record also, they have assigned for 60 people. But if you go see at any point in time, only 12 people will be there. So you absolutely, and only 12 people will be needed. Now what was the single point of failure here? I did not do a time and motion study. How many people do I need? So which means right at the point where I had raised my purchase order, there was a failure. I'll give you another example. So a lot of these FMCG companies hire trucks. So today, I would have said, you need to give me a 5-ton truck. This person will come with a 3-ton truck, load 90%, leave 10% behind. Because there's a 3-ton truck and then the next is my 5-ton truck. But he will charge me for a 5-ton truck. So do I pay? I should not, no? What truck reports to me only I should pay for it? This is another example. Because a lot of these body extended trucks that happen, so if it's a volume cargo and not a weight cargo, then I can put more, let's say, chips. Things like this, how do I determine my freight rates, optimization of loads. This is where I think money is there for companies and not in the vanilla processes that we really end up auditing. Quality, I think it's a universal problem. Who is doing the quality check? How is your quality check being done? How is the result documented? So right across, I believe that there has to be a register. Somebody has to sign it. Somebody has to evidence it. Similarly, weighbridges are another important aspect. A lot of calibration issues will be there in weighbridges. He'll suddenly say weighbridge did not work for 10 days. Those 10 days you can be dead certain there will be an audit issue. So please take those 10 days as your sample. So some of this truck reporting, so try and think of off-standard transactions in an internal risk-based audit. So you need to have a separate team for QC approval. Again, for those of you who are clients who are on ERPs, there will be something called as a quality flag indicator. That means when an item comes into my factory, it will not go into stock. It will sit in a blocked category. Only when I finish my QC process, my entry will get passed. Debit inventory, credit liability. If that quality flag is not marked, it will straight away just go and sit in inventory. Which means no, it can fail the QC. There will be no QC that's done. So these are very important. Which is why when you do audit on any ERP, you have to understand that master module very importantly. And two, you also have to understand the valuation module very importantly. Again in Tally, I'm not so sure. How is your valuation getting done? That weighted average, moving weighted average price and things like that are points of failure. Whereas in larger ERPs, it could be even more complicated. Similarly, material receipt certification. So very simply, every company must have a security register. And every company needs to have a GRN. So the timing difference between security and GRN is also very important. So delays in GRN. So I had told you, right, every company should have a very simple document that says what are my guidelines. So somebody should say all GRNs you have to take within 72 hours, not more. Then it sort of establishes some discipline. Similarly, segregation of duties. Can the same person who's receiving the material also issue it to consumption? You could have a risk. See, in fact, with slightly larger companies, I feel there is one risk. Let's say I have 10,000 transactions. How do you know there is a paper for every transaction? Today, if I have a large base of transactions, I can account for a fictitious receipt and I can account for a fictitious issue to production, and you will never be able to catch it unless you have a paper for it. Which is why when you do an audit today, even in a risk-based framework, we take 1 month and I just go on checking whether at least a document signed by somebody is there. Is there a gate entry seal? That's all we check. But it's nice to check it for a month. So you don't really do only risk-based audit, you have to combine it with some amount of transaction testing. And that's exactly what I'm coming to. I'm finding that of late, first principle failures are very huge. Somebody is continuously giving work to a contractor who's physically not even present in that place. He's not present in his GST registered location also. He's not there in his vendor master location also. Then what is the integrity of the process? Please go through. Look at your top 10 civil electrical contractors and all the clients you work with, you might have a challenge. The another problem is if you come across something which is larger than 1 crore, then you get affected by that 14312 reporting. As a statutory auditor, you have a responsibility. Asset alienations is another thing. When you do your statutory also, lot of cases there are cars which are in the name of the company which are not there with the company. It's all gone off to the owner. It's been the RC is also transferred, but our auditor has not seen it and continues to reside in my block. In fact, some of these things when I go back, when they made the change to Caro and they said title deeds and all that, I was wondering why they are saying all that. Now I'm able to appreciate why, because there have been failures on all those counts. Similarly, payment processing, these are the basic. Three-way matching should be ensured meticulously. GRN, PO rate, invoice. So GRN quantity multiplied by PO rate must be equal to my invoice, and how your company handles variances is also important. Who approves variances? See, if my purchase order has been given only at 10 rupees, but today I'm going to take an invoice at 13 rupees, the difference between 10 and 13 has to be approved by somebody. Again, you just go through on a case-to-case basis, you will be able to identify exceptions. Similarly, bills are not to be sent to the user, but should be received independently. Because what will the user do? He'll keep it to them and say, okay, pay me 1,000 rupees for every payment. Similarly, checks payments should go directly to users. Controls over NEFT and bank transfers, very important. MSME payment protocols, IBC notices to be properly handled. So I know there's a company in Chennai called Wabag. They took an IBC notice very easily and then got admitted also. And then they had to finally go and sort of set aside the process. Public notice had been given. You can sort of bring an organization to its knees. You have to be very careful if you get a Form 4 or a Form 5. So these are largely what I think is procurement related. So right across the spectrum we have seen, how do I empanel a vendor? How do I know whether I need a product or a service? How do I source it? What is my competitive sourcing protocol? How do I raise a purchase order? How do I document a PO? How many of us have seen whether your clients have standard terms and conditions printed behind the PO? If I am giving a work to somebody, should I not have a liquidated damages clause? These are very, very good internal audit recommendations. If there is a delay in delivery, should I not charge interest? Because today when my customer is giving me a format, I am signing all this. So please look at what you are signing for your customer to what you are getting from your vendor. What you get from your vendor should be more than what you are agreeing to your customer. These I think are very important from an RBI perspective. Whether I am protecting myself from all kinds of risks. Similarly, my contracts might state that he has to give an advance, but I am not collecting the advance. Why? So then you had the sourcing, and then you had the purchase orders, contract formats that you need to be careful. And then you go into material receipt, delays in material receipt, delays in servicing purchase orders, open purchase orders, amendments to purchase orders, price purchase orders given for a higher value. And then you have, of course, material receipt, quality. Quantity is generally not a problem. Again, weighment is a problem in quantity, the calibration. A lot of times they'll say, no. So first of all, if your client is big, you must tell him you need to have a weighbridge in the factory. What does it cost? 5-10 lakhs? Please put a weighbridge. So no, public weighbridge. Is a public weighbridge not working? I took my shipment fully. Either you bought 20 tons, he will record 20 tons, no payment at all. Why? Your client gets impaired, so you don't permit it. Similarly, this wet tissues will come. So if it's rained and all that, then you have to be a little careful. Then there is one more control that they check for, it's called transshipment. So the sender gives me a particular lorry number, I should receive the same lorry only. If there is a transshipment, then that means they would have changed the lorry, and there's a chance that your materials have actually got misplaced or removed or things like that. These are small things. Quantity certification, quality certification, and then you move to payment. How does your payment processing gets done? There's a three-way matching. That's one big SOX control. So SOX says you must always pay directly. It should not be given to your user to pay. But most organizations, you find your cashier himself be having so many. I don't know, again, BRS is a damn good control. I don't know how many of you have seen, there will be a lot of cases where checks issued will not be presented. How can a check issue not be presented? It will all be there in the drawer and the supplier would not have even got the check. I've seen cases where I had check issues not presented, a bunch of 300, 400 checks sitting for 2-3 months. So, either to manage their payables better, or because our friend wants a cut and says, okay, if you pay me something, I'll release the payment. Either which way. So, this is broadly on procurement. So, if you have any specific questions, I'll be happy to take it. So,
First you said solvency and liquidity.
What is time factor? To do all this, what is the time factor?
okay, I think
It is so exhaustive and check everything. What is the time?
it's not, it's a procurement, a good review of procurement should take about 3 days. Meaning, just to understand the process. That's why I say you have to first examine control design. So you ask him to say, okay boss, you explain to me from start to finish in a simple flowchart in pencil. You keep asking him questions. Can you show me a purchase order? So he'll show you a purchase order. Is this the only format? He'll say, no, for services we raise a separate purchase order. So the way I would look at it is, whatever I do, I try and do it top down. I start with a simple question. Can I have the total list of purchase orders raised by your company? Can I have your creditors ledger? These are the only 2 questions I ask. Because purchase orders where I have 100, in my creditors ledger if I have 200, then I have non-PO creditors also. Correct? That is creditors who are not going through my purchase order listing. The second thing I do is I make a top-down summary of my purchase orders by vendor. So I say, okay, these are my top 10 vendors of this company. Top 10 vendors, are they there in my tally creditors ledger? Great. Similarly, I take my tally creditors ledger and sort it. Are my top 10 in tally covered by purchase orders? Almost invariably, they will not be covered. They will say for service purchase orders, service purchases, we don't raise purchase orders, we have now all these contracts. So I have, let's say A, B, C, D, E are the vendors on whom I have raised purchase orders. In my tally, I have A, B, C, D, E, F. Obviously, every vendor on whom I have raised a purchase order, he will invariably get paid. So he will form my creditors ledger. But my creditors ledger also has F, for whom he does not feature in my list of purchase orders. So I will go and inquire this FGH. Who are FGH? They'll say, oh, F is actually doing manpower contract for us. He's the contract labor provider. We've taken 300 people from him, but we don't raise a purchase order on him. So my next question is, so who are all these people in tally for whom you don't raise purchase orders? There's F, G, H, I, J, K. Okay, these are your big people. So let me have a look at them. So with this, my top purchase order vendors and my top tally vendors, I determine what is the universe of big spends in this company. All debits to my creditors ledger are my purchases. Sorry, all credits, debits are the payments. So then I take the total and then I start looking at each vendor and say, what is he doing for me? So this is on one axis. On the other axis, I will take the material master of the company. What are the inventory that I am buying? So more or less you will know, right? So if it's a very material products related organization, you will figure this. Then you go through this whole process. So first you do a process understanding and then you straight away go into, okay, this is my purchase order, I start doing a walkthrough, I start appreciating. It's not really difficult, because you will find that in most organizations we work with, there will be a controlled design issue. My logic is, if there is no purchase order, there is no contract, what more is there for me to audit? I only have to ensure that that material or service was received, and so I have made the payment. And for that payment, somebody has approved this rate, and it is not too deviant from what is the relevant market price that I am able to do through an independent price discovery. I can't do anything else. But the point is, you'll need to actually, I think it needs partner time.
With assistants, you'll find it very difficult. They'll not be able to understand the flow and what to ask. They just go by whatever they say. They say.
Correct, but which means you need to take data independently from the system. So another important thing is, you don't rely too much on the client. You start extracting data from their system, make your tables, pivots, this, that, and then go to the client.
They don't allow.
They don't give you access to the system.
They don't allow us to extract from the system.
Why?
Independently.
Data mining.
Why would they not do that?
They find it difficult. They say, no, we have to be.
This is a statutory client or an internal? Yeah.
It happens. See, it does happen.
Oh, okay. Because that's your start point. So, in which case you can't do a top-down audit. You will just pick some voucher. But that's.
It happens.
So if it's fine, we can actually so similarly, the next one that I had thought of was contract labor. I'm not going to make this very long. We can cut this a bit short. So or would you like to do some other process?
That should be fine. Contract labor.
Anything else? But contract labor I can finish in some 15 minutes, 10 minutes. Would you like me to do any other process? Would you like to do, let's say, fixed assets? Revenue receivables. Great. Okay. So let's start on this revenue receivables. So where does revenue receivables actually start from a risk-based perspective? I think it starts from pricing. How do I price a particular product? It's very important, right? So today it's the conscious call of the board. So there are two kinds of companies, right? Where you have standard pricing, like your products with a rack rate and things like that. Another case is where on a case to case it's a contract, so I price it. So an example would be an EPC contract, where each contract has a unique price structure, or it's an FMCG where I have certain set of prices. So first is profitability. So some people might say, okay, don't get into profitability for a rack rate company. So a little is $100 and whatever, I'm not getting into it. But for companies which are on service contracts, profitability is very important. The board should have decided this is the profitability that I need to have, because there's no point in doing a contract which will make a loss, which will eat into my profits, correct? So each contract on a standalone basis needs to recover at least your fixed cost, at least its variable cost. If there's no fixed cost absorption, will go. So today if you have agreed to do something at a particular price, which is not the standard price, so first you have to find out whether the board has set a benchmark. If the board has set a benchmark and I'm deviating from that benchmark, somebody has to approve that contract. That's your biggest internal audit point. If you're doing things just for the sake of doing it, then the next is, in a revenue cycle, what would you see? Customer order. So first of all, we'll come through the same thing. A customer master. My customer master should be complete, correct? My customer's credit worthiness should have been evaluated. Would I just give my goods to anybody on credit? My credit policy should have been decided. First of all, am I allowed to sell on credit? If I am selling on credit, who can I sell to on credit? If I can decide to sell on credit, how many days should be my credit period? And can I continue to sell on credit where my earlier invoices are remaining unpaid? At what point will my credit block happen? So if I have given a customer 45 days and he is not paid by the 50th day, my system should automatically stop invoicing. You should not release an invoice. So either my system or my person, either which way. So these are things about your customer master, your credit period. Then another very important thing about revenue will be discounts. Who is authorized to give discounts? Now again, you have two types of discounts. One is the discount that you give on the invoice. So today again, in a risk-based audit, what would I see? Can I change my discount in every invoice? That's a huge control failure. Today when I'm trying to generate an invoice, the person should not have any rights to change it. If it's 100 at the back end, it should be 100 here and it cannot change anything. And if I have to make that 100 to 30, it has to go somewhere else. The person who's generating the invoice can't have rights to change an invoice price. So who will then have access to that price master? So again today when I'm looking at revenue cycle, I have a product master, I have a price master, I have a customer master, I have a tax master, I have a location master. So how do I maintain control over these masters will become very important. So today when I have given a discount, for example hospitals, let's say somebody says my T Nagar will do this knee surgery at 40,000, my Keelpok will do this knee surgery at 32,000. Now in Keelpok I am doing it for 26,000. Who has given that approval between 32 and 26? That's important. So today rebates. Now the second category is slightly more complicated. First at least is coming and falling in the invoice. The second category which poses a big risk is something called as a claim-based spend. A lot of these FMCGs will say this month you take atta 5 kilos, we'll give you atta 5 kilos free. Now whether the schemes which are claimed for are also nothing but rebates and discounts which are offered. But they are post-sales discounts and not pre-sales discounts. How do I handle post-sales discounts? Who's approving those schemes? Similarly, I have an EPC contract. Suddenly, they decide I'm manufacturing a windmill and then my customer tells me, look, I cannot pay so much money. Who's authorized to do that write-off? Do I have to go legal against him? So that's as far as invoicing. Then dispatch. One of the biggest failures will be goods invoiced, not dispatched. I simply keep booking revenues. What are my cut-off controls? Again, my contracts with my customers. Am I fully secure? If my customer doesn't pay, do I have interest? Do I have penalties? Do I have liquidated damages? Do I have a system of acknowledgement of an invoice? This is something you find very funny when you work with the government. The government will tell you how much to raise a bill. Whereas my EPC contractor will be raising his own bill. So the auditor has to actually figure out whether the revenue that I am recognizing in terms of that percentage or something is commensurate. So sometimes there could be a deviation between what the government approves and what you bill, but it should keep, the gap should keep narrowing down. So that's on, then goods invoice, then hand over to a transporter. What about your insurance? Till what point is it your responsibility? Ideally, when I hand over the goods to an independent transporter, my sale is complete. So am I following that? Then there is a shipment, a movement. My customer says, oh, you sent me 1,000 cases, but I've got only 900 cases. I should be able to recover from my transporter. So if he acknowledges a goods received only for 900, then he will raise the claim and he must get an insurance from either one of us have to claim. Then there is, in revenues, what else can I think of? Debtors aging. How do I manage the aging? In the interim, how do I ensure that you can't book a fictitious receipt?
Sale.
Yeah, a fictitious sale I can book. I can even book a fictitious receipt. I've seen companies which have booked fictitious receipts and fictitious payments. Meaning, the receipt will be there in the bank book, but it will not be there in the bank statement. You ask him, why did you do it? He will say, oh, it is a PDC, we didn't know where to keep it safely, so we parked it. I said, very good, yeah. If it's a PDC that you have parked, it should come in the BRS. Where is your BRS? He says, Madam, BRS was in the system and the system crashed. I said, okay, very good. Now, you booked it this month. You booked your PDC this month. Okay, but finally that you would have encashed the PDC at some point. After 3 months at least I should get the money, so show me that bank statement. He said, no, madam. The customer paid my vendor directly. So, I had reduced, and in the meantime, somebody had submitted a stock audit report and a receivable audit report to the bank. So, it was taken to be evergreening. See, some of these small things, maybe we think everything is great, but sometimes it makes sense. When we were doing our articles, they'd say, no, you have you checked the bank statement. Say nowadays we check only the bank book because you assume that it's okay. In fact, in this there was a particular flag because I said, how can there be so many cases which is not there in the bank statement? I said, won't they all do fund transfers? And interestingly, I don't think the PDCs even existed. I said, so where is the PDC? He says, we don't know where it is. So,
Single entry then?
no, it is multiple entries.
No, second effect is not being given.
No, BRS was, so no. So what did they do? Because I had fictitious receipts, I booked some fictitious payments also. So my fund balance would more or less tie in. Similarly, this case of creating 2 supplier accounts and transferring. And right across, I mean, I'm sure you'll, but I've not seen so many cases of this fictitious receipts, fictitious payments, but they do exist. Similarly, these large ERPs are very scary. Not even large, I mean, other than some very structured ERPs. So they have this famous concept of control accounts. I have seen random entries getting passed to control accounts. Ideally, all control accounts should become 0. But a lot of our clients, they rarely become 0. It's nothing but a suspense.
No, not necessarily. Not necessarily, because control accounts are for certain keeping certain controls. Does not mean that it is.
But it has to become 0, no, sir. If the general ledger and the sub ledger are matched, then your control account has to be 0, no.
Should be
Sometimes,
automated
no,
also.
no. Sometimes they use it for absorption of cost also.
Oh, okay. That is a variance account.
Yeah, so ultimately it becomes a variance account.
That is okay.
So like freight,
Ah.
freight ultimately it will go to the cost of the inventory. So they may keep a control account to see.
That is okay. Oh, that is nothing but okay, I understand.
Ultimately it has to take into the.
Okay. In which case it's like a nominal account only. So, no, I'm talking about where you have something called as a creditor's control account, where the transaction just goes through. So normally in these ERPs, it will pass an entry in the subledger, it will pass an entry in the GL also. So,
Do the ERPs have such a control account? Is it required?
yeah, for example, I can tell you one very popular control account. It's called the GRIR clearing
That
account.
is different.
That's a control account
That
only.
is only for the purpose of your clearing your your quality. Till the time it is quality. It is.
No, GRIR is before your.
GRIR,
Once you do your MIGO, it goes into GRIR.
Exactly.
Then you do the MIRO, it has to go out.
Exactly. No.
But in a lot of companies, it's never gone out.
No, actually, we have to check that GRIR account is having any older entries.
Yeah.
Which is unreconciled.
I've seen so many companies where it is still sitting.
Maybe sometimes the expenses has been booked debit and the GRIR account will be credit. The same thing, the expense debit and the creditor account has been credited and the payment already has been done. So the expenses will be doubly booked. That may be.
So ideally, my GRIR can have unmatched entries.
Yes.
In which case, you should not have a balance. Other than the last set of transactions which have to be.
Agreed.
But if I take before 1 month and do a summary of my transactions, it shows a balance.
Actually, some of the
Errors.
it is more than 2 years also.
Correct.
Aging.
And those would be errors where somebody would have passed an entry directly in the GL. But some of this is all huge value, so how will you know? And ideally, GRIR accounts are supposed to be auto posting. See, there's one more concept. Often, so in most ERPs, they will have auto posting accounts, which means you cannot manually pass an entry. So, for example, your material, inventory accounts will be auto posting. So, as you receive inventory, it will automatically debit inventory. So, today, if you have to write off inventory, only that part you will have to transact. So, one of the non-auto posting accounts is actually bank charges. You should be able to pass a journal entry only. And what is a journal entry? Something that hits to GL accounts directly. So bank charge is a journal entry. Ideally, there should be nothing other than a bank charge and inventory write-off. So those journal entries, because otherwise, why would you not go through a subledger? Inventory, you have to go through a subledger. Debtors, you have to go through a subledger. Creditors, you have to go through a subledger. Only bank. So the second leg of the entry will be in bank.
actually these accounts in fact serves us as and self-adjusting thing to see where something
Correct.
has gone wrong.
Exactly.
Ultimately, that's what it is. If
Like-
you directly post to the account, then we do not know where the problem is.
Correct. Like for example, all of us would have done bank audits, right? Even in banks there are control accounts, and the control accounts are supposed to zeroize. Absolutely the same concept of GL and sub-ledger. Like your BGL, right? That bank general ledger. So this is on revenues and receivables, and finally the receivable has to get converted to cash. And from the process of trying to sell, so before this you can have a case of an order loss. Customers placed an order, nobody even bothered to service it. To have a process to track inquiries. And I had explained to you about this OTIF, right? On time in full. You have a line fill and a case fill. So I want to see whether I have completed my work. Another thing that can hit your client very strongly can be liquidated damages for non-performance, where you have onerous liabilities which hit you. Similarly, your hedging. I sell abroad. It's a foreign customer. My receivables need to be hedged, and some of them could take longer. So it's fundamentally something like this. You just have to imagine the basket of risks that can occur. So it's like sending your child to a medical store. What all can go wrong from here to there? It's the same logic. You apply the same logic to purchasing and think that it's your money. What all can go wrong? The moment you put it down, it becomes very simple. And that is called as a risk register. So to answer your question, sir, once you make a risk register, you can actually classify it as A, B, C, saying these are all easy to catch. Those easy to catch your articles can do. For example, goods invoiced but not shipped. Very simple. All that the article has to do is, for the invoice, is there an LR? Is the LR stamped? So if you look at it, 70% of your risk register, somebody can easily do it. So for example, if I'm doing a risk register on fixed assets, you have some 55 risks on fixed assets. Whichever way you look at it, you will get only so much, which is fixed asset capitalized but not received at all. Fixed asset received but not capitalized, depreciated inaccurately, categorized wrongly, so physically not available, written off. So a lot of this you will find that your article will be able to actually get it done. You don't have to do it. So the talent also lies in taking a very matrix approach to audit and standardizing it. And you allow your system to do this risk imagination. You tell them, okay, this is my problem, what all do you think can go wrong? So that's about it. So the last part is of course contract labor. I'm not going to take very long because Rahman has also come and he also has to. So I'm just going to only touch the aspects of the contract labor life cycle. So it starts with manpower capacity planning. Does my factory, does my operation need so many people? 2, vendor empanelment and ongoing evaluations. In fact, one of the biggest risks I have seen in contract labor in factories is that to the same vendor we give both piece rated and time rated work. So he uses the same person to go change that bulb and get paid for it, and he uses the same person on a time rated basis. So how do you ensure that doesn't happen? You'll need to be careful. Purchase orders and contracts with vendors. Again, in contract labor, there's a well enshrined law in India. It's called the CLRA, the Contract Labor Regulation Act. Then purchase orders and contracts with vendors. Again, there is this P2P or a 3P. P2P means principal to principal. Nevertheless, in a contract situation, you tend to be the principal employer, but here he has to take liability for anything that happens to him. That's very important. The appreciation of a principal to principal and a principal to third party contract. Like for example, your subcontractors, where you're giving goods for conversion, they are called as 3Ps. So he has a different level of responsibility and performance. Job rate fixation, long-term agreements and wage rate determination, daily indenting. So today I will say I need 100 people. Is that process robust? Because somebody at the shop floor knows one guy and says, okay boss, give me 200 today. Gate entry protocols, attendance certification, work performance tracking in user departments, controls over time and piece rated contracts, entry and exit time monitoring, overtime monitoring. I don't know whether you know, there are overtime rules in India that says that for in a quarter you should not exceed so much, and these can actually turn out to be huge liabilities at a later date. There is a maximum limit on overtime in India. Vendor billing, vendor payment bill certification, payment processing. So under each of these you can go and evaluate your risks. What's my key risk in manpower capacity planning? Calling for daily manpower in excess of requirement. Is there a scope for fraud here? Other than this, these are all the baby points. Similarly, when vendor empanelment, can anyone be a vendor? Of course, my brother-in-law can be a vendor, my sister-in-law can be a vendor, anybody can be a vendor. But the vendor should have track record. And how do you control RPTs? Job rate fixation, excess payment and arbitrary job rate fixation. For example, I told you, right? Some state government has a rate for this. So have I taken the same rate? I will taken the same rate. Have I evaluated my current process for that rate? You need to check. Contracts with vendors. Again, a lot of this your operating management may not appreciate. See, again, in a lot of service contracts. So when I talk of contract labor, I also talk of service contracts. The risk is not in the rate. The risk is whether I need to perform that service at all. Take a large PSU, let's say Coal India. It must be really huge. There will be some installation somewhere, whatever. Or any large. Now, do I have zoning? So today, finance will approve one purchase order for painting. Okay, 25 lakhs. After 6 months, they will approve another purchase order for painting. I won't even know whether it's the same place that got painted. So I can actually end up paying for a completely fictitious contract itself. That's what you need to be careful about. This my state rate is 24 rupees, I am paying 26 rupees, all that is small money. And why not? So for example, this coal that I mentioned to you, do I need to pay for 60 people where my gang is only 12 people? Do I need to pay for a 5-ton truck when a truck that came before me was only 3 tons? Do I need to pay, for the whole month where an employee came only for 20 days? My overtime is at higher rate, right? Why should I do overtime at a higher rate when I could have, if I have consistent overtime, then I should increase my manpower, no? Because I have a shift working. So why would I pay OT at a higher rate? Is that OT real? So those kind of things. But for all this, you need to understand that number. And another very important thing, if they tell you the overtime this month is 4,76,000 or something like that, don't attempt to audit that number and reconcile that number. That's the other mistake that we end up doing. We start reconciling. No, don't do that. Take that 476 as right and start proceeding and look at the control aspects, you'll be able to identify the failures. Because that 476 could have ideally been only 3 lakhs. Because 1.5 times I've paid. Look at that opportunity there. So, contracts with vendors, double payments for the same resource, who's doing both a time rated and a piece rated job. Daily indenting and gate entry protocols, safety and security risks. See, this is something I never touched upon. After the Taj happened, I think a lot of organizations' security protocols have become very, very strong. Does your client have good security procedures? Another very important thing is all our clients may have their laptops or their pen drives which are non-disabled. Huge risk. In fact, I've noticed something very, very funny. Sometimes when I go to a spa, I would have gone to, let's say, Spa X. I will get a call from Spa Y the next day morning. I don't know how, the data gets transferred from there to here. I found a very similar instance with a medical lab. I had taken someone to a medical lab. The next day, I got an SMS from a competitor saying, complete blood count, this is the rate. These are huge leaks, no? Check it out. You almost invariably you visit a store, we will get an email from a competitor. And I think the other important aspect on this risk-based internal audits is also your ITGC. Basic ITGC. Do I have password controls? Everybody same password. Do I have screensaver? Does my system go into sleep mode after 5 minutes? Or 3 minutes, or what is this? There are some very well-enshrined 30-40 ITGC. So today, ideally, a company is supposed to classify its IT assets as A, B, C. Both hardware and software. A is mission critical. I've seen cases where their entire purchase ordering is done through a particular app. this app was not classified as a Class A asset but as a Class B asset. If it's Class B asset, I don't need to do a pre-implementation review. Some of these are the, so similarly if your client is on an ERP, there must be some, if there is a larger corporate policy, then the ERP has to go through a pre-implementation review. It has to go through its periodic checks, things like that. So I think ITGC is another very important thing. How do you, evaluate IT general controls? Forget application controls. Basic ITGC. Again, Tally, I don't know how much ITGC. Your audit logs and all would be sort of the baseline.
Date control.
Work performance tracking in user departments. So, the key risk is he can certify a labor bill without an underlying attendance record itself. Or work not done. Entry, exit, overtime. Late entry and early exits are not penalized. OT payment at 1.5 times the rate regularly, where a one cost additional deployment is possible. So, this is more or less on what I would think would be some risks on contract labor. So, and that's about it. So, any other questions? I'm sort of.
So basically you said this all for internal audits, but we can transfer
Absolutely.
to the extent what
Correct.
is required to the
Correct.
statutory audit.
Correct. So you can leave out the efficiency and effectiveness.
Effectiveness and
You can just see if there are, so if